We have Mr. Vikram Gupta with us, who runs one of the biggest domestic funds in India. A huge round of applause for him before we begin the session. Mr. Gupta, thank you so much for joining us today. And your journey in the investment space has been incredible, and that too in the domestic investment VC space. So if I go back in time and ask you, because your journey first started as an entrepreneur, so how was it like raising funds from LPs, reaching out to investors that you want to begin the fund? How was it like, and how has been the transition for you?
So I raised my first fund even before I started IvyCap in 2008-9 when I was working for another group where I raised India's first healthcare life sciences private equity fund. Okay. This I'm talking about 2008 when the markets were really bad. They started really going down quite substantially. If you remember, Lehman Brothers happened in that year. And I raised $100 million of domestic capital. Dollar used to be about 40 at that time, so I raised 400 crores. All domestic capital from various Indian institutions. These were the largest banks, insurance companies of India, who invested in that fund. It was a private equity fund which was focused on investing in Series C, D onwards in healthcare companies. And then, as luck would have it, 2010, this was the Pyramid Group, where the Pyramid Group decided to sell their healthcare business to Abbott, which was one of the largest deals of its time. And part of that deal was non-compete. And even though this fund was not non-compete, or fund was not under any competition threat, but I think the group decided that they didn't want any perceived conflict as well. So I decided to move on to set up IvyCap in 2011. It's interesting, actually, that time I had zero savings of my own. I just had an idea which I thought I will implement, and I had done a fundraising, so I had a lot of confidence that I can raise funds, and I knew that domestic market had a lot of potential. This was the first time I had seen Indian institutions. In fact, Indian institutions had not invested in such large numbers before. So I set up a concept with the IIT alumni as the anchor for the fund, with the original idea as the fund focused on the IIT alumni, raising capital from the IIT alumni, and taking a lot of support from that ecosystem. So we set up India's first IIT alumni-focused fund with the deans of the core 5 IITs on the board of this alumni trust, which became the anchor. And I went back to those institutions for the first fund itself, and we had close to 20 Indian institutions in a first fund itself. The largest banks, insurance companies, Government of India, they all invested in a first fund itself. Okay. So about 240 crores that we raised for Fund 1, 20% came from the IIT alumni, and the rest of it came from those Indian institutions who had invested in the other fund. So that's how the story began. Okay. And we are very fortunate that we continue to get the same support. 20% capital keeps coming from the IIT alumni. And now about 70% comes from the Indian institutions. And the remaining 10% comes from the family offices. So we want to also expand the family offices capital further. So we manage about 5,000 crores today. Wow. We are told that we are the largest homegrown VC fund today, with a portfolio of 55 companies. Lovely. And so we are currently deploying from a third fund, which is 2,100 crores in size.
Okay. And we have seen IvyCap having some great exits in the Indian ecosystem. You want to share stories of these entrepreneurs, how you found them, and what kind of exits you have had?
So when we invested in Purple in 2015, we put in 15 crores and took a 30% stake in the company. The company was very small at that time. Most of our companies, like Purple, came through our IIT ecosystem. So Purple is the team of IIT Delhi and IIT Kharagpur. Okay. Same thing for Clovia. Again, we took a 30% stake in the company. This was all very small investments, 15 crore investment, 30% stakes in companies. You try to do that today, obviously it won't be possible because the valuations have gone up in a different direction. We got an exit from Purple in 2021 for that 15 crore for 330 crores in a 240 crore size fund, making it India's first dragon exit. A dragon exit is something that gives you more than 1x of the entire fund as an exit value. And Indian investors have never seen that before.
Wow.
So that happened. And we are seeing a second dragon exit in a fund one itself. Out of 10 investments, 2 dragon exits was actually, so we invested in Bluestone in 2015, just 18 crore investment. And they are going IPO. So they're already filed for their DRHP. And again, that's an investment that we are seeing a substantial outcome for our investors. Similarly, even in Fund 2, we are expecting good potential dragon exits. Fund 2 was 530 crores. And we have companies like Biryani by Kilo, Miko, and a few fintech companies as well, like Lendbox, FT Cash, FinPay, and health tech companies. So we have very good assets sitting even in a Fund 2. And then Fund 3, we've invested in Snitch. Snitch, most of you based in Bangalore would know is the Zara's of men's fashion. And it's actually grown amazingly well in the last 1 year itself. They've opened up close to 40 stores, Zara format, and are doing exceptionally well. And some of these companies, our exits, obviously, we did 4 exits between 21 and 22. In Purple, Clovia, Lecture Dental Labs, which started as a very small lab and we invested in them. Today is the 4th largest dental lab chain in the world. And that we did exit in 2021. And Clovia we sold to Reliance. And PharmaRack we exited around that time as well.
Okay. So tell me, you have interacted with so many entrepreneurs over this, more than 2 decades of journey as a VC. And usually the relationship between an investor and an entrepreneur is not something which goes as a very sweet kind of a deal. So what kind of ups and downs, have been there? You want to share any particular anecdote, how you supported any of the entrepreneurs?
See, so obviously the ratio changes quite substantially when you're going from seed to Series A and then to Series B, C onwards. Series A, up to Series A, when you're actually raising seed capital, for example, I think it's a great time to be an entrepreneur at that stage because the number of investors actually out there who are willing to write 1 crore up to 10 crore checks is substantially increased in India. And I think that's a boon for Indian entrepreneurs. But I think on the other hand, the number of investors who can write a $50 million check, so on Series C, D onwards, has actually gone down in the last few years. So that is like a little bit of skewness in that kind of a thing. So therefore, so if you look at the demand-supply gap at the seed stage, I think, of course, the number of entrepreneurs has substantially increased, but the valuations also gone up because of the way the money is being invested in that space. But then that hits you later on when you're not able to raise your late-stage capital. So we are seeing now many such situations where when you're talking to entrepreneurs, they still have very high kind of hopes for the valuation, especially in deep tech areas, AI, IoT, semiconductors. These are the upcoming areas, space tech, where the valuations are all over the place. But nobody knows, where is the late stage capital going to come from. So people who raise capital early on in those companies and are now going for raising capital, let's say for even 100 to 200 crores of raise, they're not able to find investors for the valuations they're asking. So I think there's going to be that challenge for some time at least.
So what kind of checks and balances you have in place so that, you're investing, at the right valuation and of course, not just playing out in terms of the market bubble, which we have seen?
As investors, we have to build not a very large portfolio. We are very concentrated investors, right? We try to build a portfolio which can be managed well. So for a 240 crore size fund, we only invested in 10 companies. For a 530 crore size fund, we only invested in 16 companies. And for a 2100 crore size fund, we'll probably not be investing in more than 25 companies, maybe 30 companies.
So you keep temptation at bay?
Yeah, so we try to be very, very focused, and therefore we like to spend a lot of time with the founders before we invest in them, whether we can work with them and whether there is enough potential here to really scale. So that takes a lot of, effort to really be able to find the right partners. And in the process, you might also lose some good opportunities, which is okay for us. From a checks and balances perspective, we want to make sure that the founder is doing it for the right reason. And the founding team gets along very well with each other, and they are targeting the right space. And they understand the value of money and not just throwing capital just because they have capital. So we have seen, cases where just because the investors given a lot of money, the founders just didn't know how to deploy that capital, and they just kind of didn't use that money properly and became very inefficient in the process. So we want to see the capital efficiency and the mindset of capital efficiency.
Okay. Any anecdote you would like to share with us wherein the investment would have gone south, because things didn't go the way it was planned?
Yeah, so it's a very interesting. I was telling somebody, our first investment in Fund 1 didn't do very well, which was in the agri-tech space. Our first investment in second fund also didn't do very well, which was actually in the same space as Urban Company. And our first investment in Fund 3 also seems to be like shaking. So we said, we'll Fund 4, we'll start with straight away the second investment, we'll not do the first investments. But that's a joke that we've actually cracked. But I think there is always that challenge that you have, that one investment in your portfolio will probably end up not doing very well. And out of 10 companies in Fund 1, we didn't do very well in 2. Out of 16 investments, we didn't do very well in 3. And in a portfolio of 25 to 30 companies, you will expect at least 4 or 5 companies not doing very well. But even if 3-4 companies do very well, like I told you, two companies in a 10-company portfolio in Fund 1 has become Dragon. One company gave us 1.35x of the entire fund. The second would be something very similar. So you're actually getting more than 2.5x just from 2 companies of the entire fund. And then if another 2-3 companies give you even, let's say, 50% of the fund, so you're about 4 to 5x of the entire fund, which actually is very good for investors, from an investor's perspective.
Okay, sure. And going forward, these days everyone is talking about the AI boom, and I'm sure you're also investing in the deep tech space and the kind of health tech and other investments which you have made. So are there any specific sectors which you are now eyeing going forward?
Everybody's looking at how deep tech is going, how AI is disrupting the way things are done. And we are looking at quite a few opportunities in the AI space. For example, AI in healthcare, we've already done one investment called Elucidata in drug discovery AI space. There's another health tech company which is in the AI space, which is actually in the healthcare delivery space. And I think with the way the data is accessible these days and the way the data can be utilized, and especially in areas where the data is protected, like in financial services and healthcare, a lot of patient data, for example, in healthcare is private.
Yeah.
So unless that data is accessible and available, you will not be able to make any meaningful outcome out of that. But if you're able to build a product where you're able to utilize de-identified data, which is not linking the data back to the patient, then that data becomes very useful. So effectively, if there are AI solutions that can leverage a lot of data available out there, and every new system that is built is actually creating a lot of data potential out there, and therefore becoming part of a new potential product that can help you solve a new problem. So therefore, it's becoming exponentially more and more interesting to find new solutions in the AI applications, whether it is healthcare, financial services, consumer, even solving various other problems. Like we have a company called Zest IoT, which is automating airports. So they are actually using these sensors and camera vision at the gates. When a plane lands to the time it takes off, a plane has to go through 60-point manual checks. Now, there could be human errors in doing manual checks, and it could take longer time, and somebody is absent and is an expert person, then it takes much longer. So a technology like what Zest IoT is doing can actually do these checks in minutes, and therefore do a turnaround time much faster. So that's the reason they work, an Indian company working with global airports, multiple airports in Europe and UK and Middle East, to really provide that solution. And I think these are the emerging areas. Space tech, we have invested in Dhruva Space, for example, becoming a very attractive area when a company like Dhruva, which can provide very cost and capital efficient solutions for launching a new satellite in the space. And the requirement for launching satellites is only increasing. So more and more people want to send their satellites to space, and if they're able to find a solution which is very cost efficient, is very high quality, then that's great. So that's what Dhruva Space provides. And many other such areas are getting disrupted. So that's what we are excited about. Semiconductors is another area. And India historically hasn't been, big in semiconductor manufacturing or technologies in that area. But a lot of Indian entrepreneurs are now actually building up in that space. So again, exciting for us. Historically, it's been more Southeast Asia, China, Taiwan, and those geographies. So I think we are excited to see that Indian entrepreneurs are taking up this.
Okay. Any specific sector wherein you have seen, overvaluation happening and you just don't want to invest in that space, you want to refrain from that?
So you don't refrain from a sector only because of overvaluation, but I think one sector which we are still trying to figure out the right models is agri-tech.
Okay.
Something which, we're trying to really discover what is the real opportunity there. And I think a lot of capital has gone into that sector. If you look at the likes of Agrostar, Dehat, and various other companies who actually raised substantial capital. But I think the jury is still out there in terms of the actual returns in that sector. So I guess it's probably a longer gestation period sector. Okay. It will probably take a few more years before the technology really starts showing its value. But I think it will get there. Similarly, healthcare is actually a sector of opportunities, but when it comes to really substantial exits in that sector, I think it's still a few years away when you will see multi-billion-dollar exits in health tech as well. So I'm talking from an India context perspective. Of course, globally there are multiple examples in all the sectors. Valuation perspective, I think deep tech and space tech and defense tech and semiconductors, these are great sectors, but the valuations are really crazy right now there. And nobody knows what's the right way to value these companies, because the products are still in the development stage and people are valuing based on what stage of the development the product is. And very difficult to connect commercially at every stage that, if you move from stage 1 to stage 2, doesn't mean that commercially you become more viable. It's just that now you have a higher probability of success. And just because of that, your valuation shoots up. I think that's going to take some time before people really see some exits, and then they start kind of going back and reconciling that what the valuations they gave were maybe 1 out of 100 companies. If it turns out to be a multi-billion-dollar company, people may start giving those examples as see like this really worked. But I think the remaining 99 companies would probably struggle in terms of actually returning the minimum required returns to the investors if they don't correct valuations properly.
Okay. That's a good point. So I'm sure at this point our audience also has some questions ready. So I'll just ask you also to pitch in. So can we have a mic here?
Hello. Hi. You spoke about agri-tech and space tech. Just wanted to know your views for ed-tech, given the recently, few years back, that we saw the funding gone down. So what is your views in ed-tech, and what do you see in AI in ed-tech and future of
ed-tech, right?
Education tech. Education tech.
Oh, ed-tech. Yeah, I think ed-tech sector has been very unfortunate, I would say, primarily because of one player who actually ended up creating a lot of perceptions about the sector. And I think there's no prize for guessing here. We're talking about Byju's, which actually ended up becoming a very bad example for the entire sector. And unfortunately, because of that, the entire sector got hit from the investor's perspective. So even though they were very good companies, they were doing well, they were solving good problems, they were applying AI for the right reasons, they just couldn't raise their next rounds because this investor said, no, I'm not interested to put money in this sector. There's something fundamentally wrong in the sector. But I think hopefully, it should come back. Maybe in the near term, and when I say near term, maybe the next 12 months, you wouldn't see large number of ed-tech investments. But as you start seeing a few examples of companies which start coming up, I think you will see people getting more and more confidence. But right now, I think that it's a little shaken confidence.
Okay.
Is it related to low ticket size also in edtech industry that investors are little bit skeptical about funding because tier 2, tier 3 cities students can't pay like 200, 300 rupees also?
No, I don't think
free applications are also available.
I don't think it's a low ticket issue. I think that historically the sector was challenging anyways, right? I mean, it was not easy in India. The core education sector versus the coaching classes and the support sectors are very different business models, and we've seen coaching classes have done exceptionally well as compared to, funding a core education business model. I think any AI applications, like we had a company in our portfolio which was actually solving for replicating a tutor's teaching style. Because, you will always see one teacher getting more kind of audience as compared to others. So how do you create more of that style? So this company actually created AI tool to actually replicate that and actually did well. But just couldn't scale because of the funding they required, and they couldn't raise that funding. So I think it's not necessarily to do with the ticket size of the customer ticket size.
Sir, this is Nitish here. You talked about space tech. May I ask, at which stage usually you participate? If I may ask, in the TRL level, like
in terms of the product development, at what stage we participate in these companies?
Yes.
We've,
I mean, TRL 3 to 9.
yeah, so we don't participate, try to avoid participating before TRL 4.
4.
But yeah, at TRL 4 onwards, obviously the valuations also become very crazy. Especially if you're at TRL 6, 7, valuations really exponentially start increasing. So I guess it's a lot of, there is a lot of bet that you're taking in on the founder's ability to really make sure that the product is completed the way they are trying to do it. And then, of course, the timing of doing it. You know, if you don't do it fast enough, somebody else does it ahead of you, then you lose that advantage. So therefore, I mean, ideally, I would say TRL 5 is still kind of good.
Convenient.
I mean, you start tracking at TRL 2, TRL 3, but I mean, sometimes if you think that the founder is a second-time entrepreneur who's given exits before and is addressing a need which has never been solved before and nobody else can touch this area, then you might look at a TRL 2 as well.
Thank you, sir. Thank you.
So we'll just take one last question.
Hi, sir. So I just wanted to understand what is your view about the companies which are using immersive 3D technologies for and providing virtual reality, extended reality. So at what stage would these companies normally get into funding, and what is your perspective about it, sir?
You know, it's very interesting. I've looked at quite a few companies in immersive technologies, and it's both on AR and VR. And unfortunately, I mean, they look very exciting in terms of products. I mean, the kind of problems they're solving sounds very exciting when you actually see the product demos. You know, for example, a car sale dealership, you wear this headset and then you get the entire experience of the entire interiors of the car. Looks great. And similarly, on the education side, all your research work and things like those, the applications look very exciting. When it comes to commercial application side, when it comes to actual revenue generation side, I think that's where we haven't seen much happening in terms of people being able to convert into actual business opportunities. So I think, and this is, I've been seeing this for last 8-9 years now. The people are building exceptional products, but I hardly see somebody really generating huge amount of revenues from what they've developed. So I think we are yet to see some substantial value creation in that.
So with that, we come to the end of this session. Vikram, before we conclude, just one message from you for everyone in the audience who are on their fundraising journey in 2025.
So depends on what stage you're at. I think if you're at seed stage or pre-series A or series A, good news, you will have tons of investors out there. I think you will be on the better side of negotiations. Make sure that you don't accept the first check that comes your way. Get what you believe is the right for you in terms of the partner, because I think get the right investor partner for yourself. You don't just raise capital from anybody or everybody. If you're a later stage, just hang in there. This year may be a little tight in my view. You may not be able to raise very large checks immediately. In the next 6 months, I don't expect very large deals happening. There may be a few deals here and there that might happen. Even though like one of our companies just raised $150 million, it hasn't been announced yet. Yeah. But that's a rare example. And that may happen very rarely. And I think stay focused for the cause you're solving, the problem you're solving. And don't get deviated only because an investor tells you that you're not doing the right thing. I think talk to multiple people before you come to a conclusion. And stay focused on the problem you're solving.
Okay. Thank you. On that wise thought, we end the conversation.
Thanks a lot. Thank you so much.